Okay, so non-farms coming up shortly. Going to have a quick look at the state of play of the job situation in the US, and then we'll look more closely at the charts and then how we're going to tackle this from a trading point of view. So first off then, let's take a look at what to watch over this release, and then also we can go into the various data points that we've seen in the run-up to this, and is how the market looks in general to build this expectation of how the number might come out. One of the first things then to really look at is a chart here in the FT, which I thought was quite good. When looking at non-farms, obviously there's the headline figure, which the market always reacts to first, but there's several components of this report. The one that's grown of importance is the underlying wage growth, but we also get unemployment, private payrolls, manufacturing payrolls, revisions, and so on and so forth. So there's a lot to look out for. Now, the one thing, looking at this graph, you can see here is the headline payroll figure, and then you can see here tracking against the actual unemployment rate. The one thing I would say is that the market, from a trading point of view, really doesn't care about the unemployment rate at this point. That's because it's been fairly consistent. We're kind of sitting at around this 5% level now for some time, so it's been a fairly steady metric, so to speak, and certainly way down half the rate of which where we were at the height of the financial crisis. So in that regard, let's just say it's a fairly good, robust figure. Non-farm payrolls, though, has been extremely choppy, but overall I think the FT make a good point here. Its Federal Reserve policymakers and other observers note that the full employment is not necessarily equivalent to good employment, and this is really important. As a result, other metrics such as the ratio of individuals who are employed part-time but who would prefer a full-time job frequently garner significant attention. We'll have a look at the Danske kind of spider diagram. It explains it a bit better. But generally speaking, for there to be an underlying and long-term good employment situation in an economy, you'd rather it be full-time rather than part-time jobs, because then people have got better outlook over the foreseeable future, higher levels of income, then more potential spending power, and so on and so forth. The area, though, that continues to be a main driver of non-farm payrolls in the overall aftermath, certainly last month was a classic example. 287, severe bounce from 11,000 the month before. We spiked and then we reversed on the back of the fact that the wage data, the underlying metrics which the Fed are watching closely, did not live up to expectations. This wage growth here, so Fed officials are waiting for conclusive signs of wage growth and a rise in the rate of inflation as they determine the timing of the next interest rate rise. Now, I do think that this is very important with this release in terms of however it comes out, whether particularly strong or very bad, I personally do not think it makes any difference whatsoever in terms of the Fed. We've already discussed this morning that from a Fed point of view, certainly the market does not think the Fed are going to hike this year. 8% for September, tracking around 29% for December. So certainly looking increasingly unlikely, particularly in the context of aggressive easing yesterday from the Bank of England and expected further easing from the ECB and the BOJ. So policy divergence, the strengthening dollar likely come on the back of that, and if they were to raise rates, that would impinge then their economic recovery and likely tip them back in recession. So very much the Fed sitting on their hands at this point in time. Now, the one reason why I say I don't think this is particularly important from a policy perspective is because if you think back to the FOMC statement we saw most recently, the Fed were fairly robust about the job situation. It's not jobs that they're concerned about, it's inflation that continues to remain low is what's holding them back at the moment to a certain extent. And now obviously you've got this Bank of England measures that we saw yesterday, which they'll have to take into account. So even if we got a forecast busting number, let's say 300,000, are the Fed going to hike rates? That doesn't really make any difference in my opinion, because they already know the job situation is fairly robust. We had 287, don't forget, last month, and they still didn't hike rates. So what difference does a 350 type number make? I think very little. In terms of if the number came out at 10,000, now let's have a look at payrolls on that premise. Let me just move it over to this chart. So let's say we get a number down at 10,000, more akin to the number 2 months ago. Does that make a difference for the Fed? Well, no, because the market's already expecting the Fed not to hike anyway. All it's going to do is delay the hike even further. But all being even, I would say the Fed then just need to see another month of data in order for it to define a bit more of a trend. If a data set went from 144 to 11 to 287 back to 10, then you're going to have to see more consistency out of that data set, and that means you'll have to wait for more data to come in. Now, what I'm saying then is that I think this makes ultimately very little difference for monetary policy, but what it does mean though is there are going to be trading opportunities here for sure. But before we get into that in more detail and look at the charts about how that might play out, let's just take a look at the context then of the other data points that we've seen in the run-up to this release. One that's followed fairly closely is ADP employment change. That came out midweek. 179,000. That was actually a touch above expectations of 170. The previous seeing a minor 4,000 upward revision. But overall, ADP, steady upward trend and fairly consistent. Certainly not the erratic chart that we've seen with the actual Bureau of Labour Statistics report. So that's been an overall slight positive. You then move over to ISM non-manufacturing. And although that came in a touch below expectations, 55.5 was the reading against 56. The employment constituent came in at 51.4 against 52.7. So both figures were slightly, I would say, lower than the prior month, and certainly the headline was slightly lower than expected. But remember, 50 is the key between expansion and contraction in these particular PMIs. And so, from a US perspective, we're still fairly healthy on those metrics. And from an employment point of view, although the constituent declined, it was still up quite cleanly above that 50 level. If you switch over to the manufacturing side, that was a decent number. That came in at, well, this is the market US manufacturing PMI. That came in at 52.9 at the time. The actual ISM manufacturing, 52.6. And the employment constituent was 49.4, so not quite as solid on the manufacturing side as non-manufacturing. Then you've got challenger job cuts, 45.3 thousand was up against 38.5 previous. And in terms of initial jobless, those weekly jobless claims, they continue to track fairly in line with expectations and around the lowest they've been since the beginning of the year. What all of these data points then are telling me, and this is what traders do, they look at these employment reports from these individual, let's say, subsection of data that comes in throughout the week to then gauge an expectation. And I think the market consensus, which today is for 180 on the headline, seems fairly reasonable on the back of these metrics. So let's just take a quick look at the charts and how this might play out. One important thing to look at to start though is what are the ranges. So as you can see here, the headline today expected at 180. You've got a low estimated range by those surveyed on Wall Street of 140 to a high of 240. And then you've got the whipsaw price action of the previous, or price data of previous, 287, 11,000. On the street, the most bearish, I think you guys are getting the drift. If you've traded long enough now, Deutsche Bank always the most bearish, 150. So they're quite a bit below the consensus reading, toward the low end of the overall range. All the way at the top, Barclays going for 200 of the bigger names. High, obviously 240. Looking at Amplify's expectations, all you guys, pound in the cup, you've gone for 177 as your average expectation. Very, very close to the headline expectation. As you'll find, as you get more experienced, you're going to have to be probably a little bit more creative with your guesses, because it very, very rarely comes in with the median consensus that the street's looking for. But, let's see. The range for you guys, you're looking at 150, low ball, a high estimate of 224. I'd like to speak to whoever came up with that number to see how they calculated specifically 224,000. I'm sure that would be an interesting conversation who came up with that one. Okay, so that's your range. And the reason I point this out is that the range is crucial in determining then how the market might react. Because generally speaking, that's going to define then the size of the moves that could well come out of the report. First of all, just looking at the E-mini S&P. Now I think arguably on this piece of data, the S&P is going to be the toughest one to trade. That would probably be the one I'd be least looking to get into. That being is that it's been fairly desensitized to data really. We continue to trade just shy of those all-time highs, if you remember. So that now standing at around that 21.77 3/4. I don't really see any number that can really threaten to push back up to there, because as I say, a stellar number I don't think really changes the game too much from a Fed point of view. If you did get a strong number, then certainly you might get a bit of upward price action, but I feel it might be fairly contained. Probably 21.70 reasonable target in that scenario. Flipping over to Treasuries. Now Treasuries sitting at quite an interesting level here. This is looking on the last 5 months. Now if you look at this area here, that was the Treasury move that we saw and tested up around that 04.5 on the back of the disappointing GDP on Friday last week. That was when it came in at 1.2%, obviously way below expectations of 2.6. Very disappointing. Treasuries rallied on the back of that, and that was a predominant reason as well why the Fed has really pushed a Fed hike off the agenda in the near term, or at least from a market perspective. That then bounced back off that level, so that's a level upside. If we get a weak number, I'd certainly, given that we're in very close proximity to it at the moment, only around 4.5 ticks, maybe you'll get a break, a pullback, and a potential for a classic long then looking to go further to the upside. You know, those highs from earlier or late June, early July, not seen until just above that kind of 134 handle. Looking elsewhere, the British pound could be quite interesting as well. I would say for the time being, technically we're kind of confined here to a range of around the 132, which pretty much coincides with that pivot. And then downside, the post BOE announcement, you know, the surprise, the full Monty from Mark Carney saw us test the low at 131.33 in the aftermath. That got tested a couple of times. So you've got that with 10 pips below obviously the 131 handle. Now, as I say, although I don't see this non-farm as being a game changer for policy, certainly a number, if it did come out at the top end of range, so let's say 200 plus, I certainly would expect the dollar to see some strength. And if that materialized, then certainly this 31.11 is a key level to keep an eye on. If it's a very strong number, let's say 250 plus, then certainly a break of that and the 131 could see then extension of losses to the downside. A quick look at the other asset that we've been talking about a lot of late is gold. Again, this is kind of a 1 month view of gold that I'm looking at here. We trade at 1368 spot 3. If you look at where we're trading right now, look where we were post Brexit. That was the night of the Brexit, or the morning when we came in. So we are bang on, almost to the cent of the high, technically, of where we were on that fateful night of June 23rd, 24th. So upside from here, I'd certainly say a retest of the earlier August levels. Now that's on the premise then you're talking about a move from 68 to 75 on a retest. That'd have to be a number pretty weak. I'd be looking more something akin to a kind of sub 75, maybe more like a sub 50 number for us to really give gold a shot in the arm. Technically then if we got above that 74, there's a bit of clean air on the upside. And as Will was saying in the briefing this morning, certainly from a policy perspective, a Fed rate hike then is certainly off the agenda. And then gold on a more, I'd say, medium-term basis still looks good to eventually, if we get above these previous highs, 1400 looks almost inevitable from the way that central banking policies are heading at the moment. As ever with this report, as you saw last month, try not to get caught up in the initial market volatility. the market always reacts to the first headline in the initial spike, but that does not mean that that will be the definitive lasting trend, because there's other data points you need to contemplate. The wage data is really key to cementing whether that move, that initial move, is going to be sustained. Then also you need to look out for revisions to the previous and the 2-month net revision. All these things need to line up in one way, painting a good picture of employment, i.e. headline strong jobs creation, strong underlying wage growth with upward revisions to the previouses. Then we could see a bit more of a sustained move in the dollar, and then vice versa. If the data is conflicting, that's the most difficult to trade. Then you've got to be a little bit more cautious about your entries. As ever with non-farm payrolls, and in the context of like what I was saying about if the number is particularly out of line, I'd be looking to action trades with pretty short time frames, because ultimately I feel that the market will look at this fairly objectively, trade the event. Ultimately, very little changes the game for the Fed, so therefore I would not be looking for sustained trends going all the way into the whole US session. I'd say probably more so will be the case as we'll have an hour of volatility, the street will open, we'll get another bit of volatility at 2:30, and then probably by about 3:30 show's over. And as Will was saying this morning, the way that trading floors, certainly in my experience over the last 10 years, anyone who's still hanging around on their desks after kind of 3 o'clock, they've probably had a bad day because your opportunity has been and gone. And so that's kind of the way that traders act. In and out. If, like I said with Will showing some trades yesterday, if you do take a trade over periods of high volatility, one of the key things here is you must be confident and take it with conviction. Any hesitation means you're going to lose that opportunity. If you don't feel comfortable, then don't take it. Okay, guys. So 1:30. Good luck. And whoever went for 224,000, please come to the desk. I want to speak to you and know your methodology. Good luck.